There's been so much tension and so much breath holding over this specific election cycle that the good news is whether it was the best outcome ever and you were a big fan of what happened where the Republican Party took control of many different aspects of the government, or, this is something that causes a little bit of unease. We do have one benefit that we have today, and that is certainty. There's one thing the market hates, it's that lack of certainty. So now we're going to dive in today and share the perspectives, the pros, the cons, the pitfalls, and most importantly, how you as investors can take advantage of the opportunities that we have ahead for our country, the biggest economy in the world, and for really lasting changes that could impact us for generations. What this entails, just to start the zoom in a little bit, there are seismic shifts taking place in tax and economic policies. Some of the biggest shifts that we've seen really in 4, 5, 6 presidencies that we have seen in decades, and they're happening right now. So I'm really excited for this topic. What specifically that looks like, we're going to go over today. We're going to go over taxes, U.S. tax policy, the implications of Donald Trump's presidency on that. He has one more term left. He's already been president once. This is his second term. So there is no re-election. And he also has a lot of wind in his sails throughout the government. So what decisions is he going to push for and go towards on taxes? Next is tariffs. Tariffs have been a huge source of questions about what the impact would be on the economy, what the impact would be for individuals in our country, and how that would look really for geopolitics and geoeconomics going into a very touchy world with a lot of tension and a changing landscape of what trade looks like. Next, we'll go over some interest rates. What are the impacts on interest rates? We'll go over inflation, directly tied to interest rates, and those two overlapping quite a bit. We'll go over investment implications, what markets will have what impacts, and how that's gone previously, what that might look like in the future. And then we will go through some expert projections. We won't say predictions, right? We're not allowed to say predictions. We got to be nice to our attorneys, but we will say projections of what we see and what we expect with the data that we have today and what that will likely look like. So before we get too far, who am I? My name is Nick D'Angelo. In case we haven't met yet, I'm president of Saint Investment Group. I'm also founder. I range from a thought leader in real estate and the investment world. I get to appear on amazing podcasts, amazing stages throughout the country with a lot of really great people in the real estate and investing world. I am proud to say that our investments at Saint have had really good performance, and we have a lot of amazing investors, many of which are joining us today. I'm just kind of checking out the list of, hold on, I'm going to pull up the attendee list. I want to make positive. This dropped off for a second here. There we go. Oh man, it's gone up a bunch. Look at that. Okay. So, I'll say that the number one thing that I have to brag about at Saint, I could tell you all kinds of things about me personally. My favorite thing about Saint is our team. I could brag on our team all day long, but what we've been able to do is scale our income fund, which is our flagship investment opportunity, to over 500 mortgages in over 21 states and growing. Totally, if we take into all assets under management, we're over 206 million in assets under management. We have fixed return options that range from 12 all the way up to 14.28%. And what I'm most proud of with our investors is that we've never missed a distribution to our investors in over a decade. We've been always on time every time. Your money has been safe with Saint and will continue to be so. I love this slide. It's a brag slide. But it's one we're very proud of. We have exited over 7 deals. Our last 7 deals averaged 35.5% IRR, over 13.4 million distributed to investors, over a decade of consistent consecutive distributions, healthy assets under management. I love this slide. But don't take my word for it. Here's a few people that have great things to say about Saint. We also have all this on the website. I encourage you guys to take a look at the website. We have testimonials. I encourage Googling us, whether it's our Trustpilot, whether it's our Google reviews, etc. Check us out. See what people have to say. I'm really proud of it. And again, what we cover today is most importantly about your investing and your financial future and how that impacts you moving forward. So I can't say enough good things about what we have to offer. I think we fit very well in this economic environment, paying above average returns up to 14.28% and a fixed income opportunity. But most importantly, check out how it fits in your portfolio and how that might work for you. Okay, so we overviewed what the topic breakdown is going to look like. This is a quick breakdown of what we're going to cover structurally. So we'll go through a legal disclaimer in a second. We'll jump into the topic. We'll go through some housekeeping at the end, and then we open it up to Q&A, which means you can ask any question that's on your mind about any slide, about anything in the investment world today. These Q&A sessions have by far been one of the most unexpected, amazing benefits to these webinars that we've seen ramp up massively. We love engaging with our investors. We have a lot of great investors we can brag about, but these Q&As often answer questions you didn't even know you had. So I encourage you to stick around to the end. And we also have a little bonus for you at the end through the Q&A section. So I'll give you a second to read this legal disclaimer. Really, it's not too exciting, but here's the big 3 takeaways. This is not investment advice. This is for educational purposes only, and all investments carry risk. Okay? Basically, what we're going through, Saint spends a ton of time, a ton of effort, and a ton of energy to have the best economic data so that we make the best decisions we can. We're just trying to share that with you guys for free. We have no, course or class or anything like that. We're already doing the work, so we'd prefer to just pass along to our investment community. We find, kind of selfishly, that as our investors know more about the world around them and the economic environment we're in, they understand why we do the things that we do better, so they make better educated decisions and more confidently invest with us. We want them to do whatever works best for them and their portfolio. Okay, here's bonus number 1 today. I'm pretty excited about this. We are giving away our new thing that we're doing is a book giveaway. The book this week is Economics in One Lesson. This book, while it might sound like it's entry-level economics, it is basic economics, but this book does something unique of all the economic books that I've read. I love economics. It's a huge passion of mine. This book particularly takes extremely complex data and concepts and details, and it distills very efficiently. So I probably listen to this book still once or twice a year just to stay really grounded on the basics and the fundamentals. So here's a link right here on the screen now that you can scan and either buy the book for yourself, or we're going to be giving away copies. Here's 2 ways that we can give you a free copy of Economics in One Lesson today. 1, the best contributors in the chat. Drop questions, drop comments, drop emojis. We love all of it. Good energy and good thoughtful discussion. And then the second way is people that ask great questions, the best question askers in the Q&A at the end. We're going to send you this book. But either way, here's the link now. You can buy this book and check it out. It is a wealth of good information. All right, we're going to kick this off with some quotes from some really smart minds. The first is, I'm proud of paying taxes in the US. The only thing is, I could be just as proud for paying half the money. Next is a guy named Albert Einstein, a little bit of a thought leader, a little bit of a smart guy. And even Albert Einstein commented on the tax code saying the hardest thing in the world to understand is the income tax. And then Will Rogers, the difference between death and taxes is that death doesn't get worse every time that Congress meets. Hey, Brian, thanks for the thumbs up. Glad you read that book, by the way. That's very cool. It's a very powerful book. So we're going to zoom out and zoom in. We want to make sure we have some background with everything that we are going into today and we understand where it all came from. From the inception of the federal income tax, which started in 1913, the point, or all the way through the Tax Cuts and Jobs Act in 2017, there have been massive changes to the tax code. Donald Trump has made some of the largest changes in his first presidency, and we see some of the biggest changes on the horizon coming up. Now, to give the backdrop and to make sure we're all on the same page, we need to understand what exactly roadblocks Donald Trump may have politically. Not much. Probably the least amount of roadblocks politically that we've seen a president have in, I don't know, several decades. To recap, the Republicans won the presidency. They won the electoral college, meaning the presidency, but also the popular vote, also the House of Representatives, also the Senate, also the governors, also the Supreme Court is controlled by primarily elected by Republicans that are sitting on the Supreme Court. To make it even more extreme, Jerome Powell, the Federal Reserve chair, was appointed by Trump previously. So the world that we live in the United States, is a red Republican world for at least the next 2 years. Donald Trump and the people around Donald Trump setting new policy will have close to no issues or hurdles as they set policy moving forward. Now, 1913, that's an important day. The introduction of the federal income tax was in 1913. But before that, the most significant source of federal taxes was levies on imported goods. So imported goods had a tax. Does that sound interesting? Does that sound like something we're dealing with today? Maybe a tariff, right? So tariffs are not new. This is a huge source. This is a huge historical source of income for the U.S. government that was used over 100 years ago. Now, in 1913, Congress enacted the personal income tax to shift some of the burden to wealthier people. So for the first 70 years of income taxes, the system was designed specifically to assess higher percentage of taxes on affluent Americans. Okay. Now, tax the rich. I'm just going to make a note here. Tax the rich is nowhere near a new concept. Neither is tariffs. Neither one of these are new by any means. The discussions we are still having today. Tax the rich has been around for over 110 years. So the question we can say here, the two questions we can have here at this stage are, is tax the rich working? One. And then two is, are tariffs working? Because we know these have over 100 years of background. We'll dig into both. So again, this is kind of a breakdown, 1913 being the start of the income tax. Here's how the brackets break down. By the way, Ange, can you see my cursor? I was curious about that.
Yeah, we can see it. So where you go, where our eyes are following.
Perfect. So we see that the income tax rate started at 7%, 1913, on people making the equivalent today of over $11.5 million a year. So pretty high barrier of taxation with a pretty low rate. Now, just like any government taxing policy, typically it's going to go up over time, or any government access to more rights or more opportunity for the government. So you see 7 to 16 to 67, all the way to 77. Granted, we were in World War I. So these were desperate times. They called for desperate measures. We needed an income tax rate. We needed a tax rate to support that war effort. Post-war, we see it go back down to 25. Pretty big jump to 63, all the way up to the record in US taxation, 94%. But again, we're in a world war right here, right? But they dropped the barrier. That was the equivalent 94% tax for people making 3 million and more. So at first it was 11.5 million. Now it's for earners 3 million or more, up to 94%. Just some interesting notes to see the history there. Now, as recently as 1981, the US had a top tax rate for personal income of 70%. Now, there's a little bit of breakdown here for single filers or joint filers, etc. But for reference purposes, let's think about this on $215,000 in income. That's a tax amount of $151,000. So if you're thinking about taxation based on your efforts as a worker, somebody who contributes, somebody who pays their taxes, if the government takes over 2/3 of your income, that means that if you broke down your whole year, all 12 months of your year, then the first 8 months of your year, you are working just to pay the government. Okay. You wouldn't start making money for yourself in that tax structure until September. And then September onward, you get the honor of keeping all that money yourself. So that's what it looks like at a 70% tax rate, just to kind of give you an idea of what that might look like for literal efforts on your daily time and efforts in the office, the workplace, etc. Just a little breakdown. 1981 was a major shift in how we started approaching taxes a little bit differently, specifically tax cuts, specifically how the Republican Party started approaching taxes from a little bit of a different angle. We have a lot to break down there, but Reaganomics, if you want to talk about it from that perspective, really that only amounted to about 2.4 billion in today's dollars spread over 6 years. The bigger trend and the bigger impact was what this led to later on. Also, Ange, you beat me to it. Cynthia, thank you for the great questions. All questions drop in the chat, guys. You can drop in the chat as we go. If there's a really pertinent question that has really good timing or something we need to drill down in that exact second, we can jump into it. But most questions we're going to leave to the end, and we're going to open up Q&A and have some really good discussions. So if you have questions, feel free to drop them in the chat. Ange and the team will be adding those to a list, and we will not miss questions in our Q&A at the end. So tax reform along the way, just kind of checking in on a couple things. We saw, different tax adjustments, reducing the top rate to 28%, kind of the biggest note from 1986. Now we have some background here. We see 2001, 2012, and then we have the Tax Cuts and Jobs Act. This brings us into the modern era. The Tax Cuts and Jobs Act is a Trump 2017 tax structure that he implemented. So this made several significant changes to tax laws for both individuals and for corporations. I want to make that very clear that this benefited both. Many of these are set to expire in 2025. We will see if that happens. We will see what specifically does and does not expire, with Donald Trump having very little resistance politically. We'll see what he chooses to stick around with. But here's a list of something set to expire in 2025. Child tax credit, SALT deductions, estate tax exemptions, etc. Kind of a pretty exhaustive list. Excuse me. If you see me clearing my throat or coughing, I have some sick kids at home, so just bear with me. Notable changes for corporate filers. These are not expiring at the end of 2025. We have some reduced taxes we have a reduced corporate tax rate from 35 to 21. Created a 20% deduction for qualified businesses, 100% bonus depreciation. There's a lot to go into here. We could spend a lot of time on this, But just so you know, this was for real estate investment primarily. Donald Trump, lifelong real estate developer, lifelong real estate investor. This bonus depreciation was substantial. This gave individuals the ability to have a massive write off and to incentivize them to be investing in real estate. Now, I'm in the investment community. I am a huge fan of real estate. So I'm obviously a huge fan of 100% bonus depreciation. And I obviously think it did great things to incentivize people to take their finances and their investment and their retirement into their own hands and make moves to do so. That has scaled back. That has a lot of details to it, but I wanted to make a note on that point specifically. Oh, John, I love your comment. We'll talk more about that on some tax advantaged opportunities through Saint in a little bit. Don't worry, John. We'll definitely get there. I will not forget that piece. So I'm making a note here. Donald Trump took a lot of flack for specifically the corporation benefits, the corporation tax advantages. Let's talk small business in the US for a second. These stats are why small businesses garner so much interest and, frankly, in my opinion, deserve so much focus from the government. 99% of businesses in the United States are small businesses. And 100% of businesses in the United States started as small businesses. They all started somewhere. Small businesses employ 2/3 of new jobs in the US. Also, small businesses account for 50% of the gross domestic product of the economy of the United States. So, this without overstating this, I don't know how to overstate this actually. Small businesses are the backbone of the United States. Disproportionately important, extremely important. So important, in fact, that even Kamala Harris acknowledged this and knew this, how important small businesses were. Even her proposals included many policies to prop up small businesses. So I can't overstate how important small business is. I fully support ways to incentivize people to start businesses, to grow businesses, to boost the US economy because of how powerful they are. Here's a breakdown. As we peel back the TCJA, the tax structure that Trump put in place in 2017, here's how it would affect different tax brackets. I'll let you take a look at that. What we would see is the top 1% would pay an additional about $70,000. The top 20% would pay about $9,000 a year more in taxes. And the bottom 20% would incur a tax increase of about $13. So it affects different tax brackets differently. And this is just, I don't know, it's just an interesting thought experiment to see what exactly that would impact on each level of taxpayer. So tax policy and spending levels determine the deficit. Just like our personal budgets, everybody here, we are consumers, we are civilians, we are citizens. We have to run our households based on how much we make and manage our expenses accordingly. We don't have an endless supply of debt that we can just pile on top. We have to be conservative with how we spend our money at home to make sure that we don't go off a cliff or AKA increase our personal deficit. So currently the national debt is over 35 trillion. It's actually 35.8 trillion. What we're seeing here is a breakdown of what the cost to the US government is on the current amounts of debt. The first, right now, if we look at what we're doing or what we're paying on that debt today, it's almost 900 billion that we will pay on our debt in 2024. In 2034, 10 years later, that almost doubles. So these are substantial. There are risks that are directly associated to this rising debt and the cost and the payments that we make on that. You can see some of them outlined, but most importantly are these three. It threatens our ability to respond to situations. We don't have as much flexibility. We don't have as much cash and money in available to jump into situations like COVID, to jump into situations like the global financial crisis. We need liquidity as a country to respond accordingly. And if we don't have that, we are limiting ourselves to be the most effective in responding to unforeseen circumstances. This also increases U.S. reliance on foreign creditors. About 1/3 of U.S. debt is owned off is owned foreign owned, right? We'll go down to a breakdown of who owes what, who owns what of our debt, but about 1/3 of that is owned by other countries. So that we have a reliance to some degree, if we keep offloading our debt and exporting our debt to others, that once that's sold, or if that's sold, that could have a very negative impact on things like inflation rates, etc. Also, we are jeopardizing our investor confidence in US debt instrument. If you see that Standard and Poor's dropped our credit rating previously, that is for issues like this overwhelming debt that's ramping up. And who is adding to the debt? That's a big question. That's a big question. We'll start with the Republicans. I talked earlier about how there was a big shift, specifically in the, around the Reagan era, because Republicans historically have taken a conservative approach. They've been seen as branded as the conservative spenders. They don't want to overspend and they want to have balanced budget. In the 80s, this started to change. We started to see a different approach from the Republican Party. Reagan cut taxes. Okay, this was widely liked by those that were paying high taxes. So many people liked this. The issue was he did not make spending cuts to go along with that. Okay, why? The bigger question is why. So we've seen the Republican Party in the last handful of presidents move towards it's not directly stated, but it seems to be and appears to be a growth strategy. The idea is the trickle-down economics approach. It's that if you cut taxes, then what happens is it grows the economy, and that's a net gain for everybody, right? The issue is that also creates somewhat of a deficit or a definite deficit if you don't reduce spending also. The next is you look at the Bush administration. Increased military spending. Bush brought us into some wars. We had some bills to pay that went around directly for military spending, and he further cut taxes. Not a lot of spending cuts under Bush, not enough to make up for a deficit structure that was beginning to come around by the next Republican president. Then we have the Tea Party movement. This was a turning point for a short period of time where the Tea Party was aiming to redirect the government, the Tea Party was aiming to redirect the Republican Party back to having balanced books, to have a more conservative approach. From there, we had Donald Trump jump in. He was the next Republican president from there. Some great things. He did some amazing things internationally. We had NAFTA 2. We had some new trade agreements. We also had COVID. We had a lot of money spent there. Deficit is an understatement, especially in the COVID side of it. But the other half of the coin, the 49% of the country, I guess, from the voter pool now, but let's say half the country, right? The left-leaning side of the country, Democrats obviously also are in agreement that deficit spending is a preferred method. So if there's anything that both sides of the aisle can agree on, it's that we want to spend more than we make as a country. Okay. That has been very demonstrated for 30 plus years. President Obama, under his tenure, we can see we went from about 12 trillion national debt to north of 20. Obama, a lot of, he had the global financial crisis, to be fair, but also spend a ton on all kinds of other policies. Here's an interesting note. Obama extended the Bush tax cuts. Okay. I want to make that note. So one party is supposed to be fiscally conservative, the Republicans, but they have deficits also. One party, historically was supposed to be for the little guy, for for the Labor Party, et cetera, et cetera. They're extending tax cuts. If you look at Biden, he's extending a lot of Trump era policies. If you look at Biden, he's extending NAFTA too. He still extended tariffs from the Trump era. So the Democrats and Republicans do more and overlap more in policy than I think most people realize. That's just a quick highlight. Oh my gosh, we have a spending problem. So what do we do about it? And what does Trump, in the middle of a red wave, what is Trump's plan to get this train back on the tracks? Doge, the Department of Government Efficiency. Now, there's a lot of things we'll get into. I have a lot of optimism right now. I also have a lot of things that I am concerned about that I'm keeping an eye on. This is one I don't want to waste words. I'm extremely optimistic about. Elon is he's a figure that is divisive in modern politics. A lot of people don't prefer him. He has moved more to the middle right. Where previously he was an independent or, seemed to be an independent. That said, no matter where you stand on Elon, I'm just going to give you a quick list. PayPal, SpaceX, Tesla, Twitter, Starlink, Neuralink, etc. No matter where you appreciate or don't appreciate his politics, Elon is Hall of Fame CEO. He also happens to be, I think he's still the richest man alive, right? Somebody drop in the chat, confirm that he's the richest man alive, right? I think he is, right? And then Brian, you're right. Elon has trimmed every company he's owned, right? So this is not new to somebody like Elon managing efficiency and trimming things that need trimming, even when they're deep, difficult cuts. Here's something interesting about Doge, the Department of Government Efficiency. It's one of the few government agencies that has a projected date, that has a date of firm completion. On July 4th, 2026, the Department of Government Efficiency sunsets. So it's a short window to get a lot of things done, but I'm very optimistic of what Doge can do for cutting the expenses. We spend over $6.5 trillion per year as a government in the United States. If they can trim that back, that significantly puts the country back on track. Here's some quick stats to go along with that. The number one largest employer in the United States is the U.S. government. Let that sink in. The United States government employs around 20 million people. Okay. So here's the good news and the bad news. If the government does if Doge does a 5% cut to government jobs, it's pretty substantial, but that's 5 million jobs. I'm sorry. I got my math split up. A 5% cut to government jobs is 1 million people that are being cut from the job pool that are now unemployed. If Doge makes a 10% cut to government jobs, that is 2 million people being added to unemployment. Now, this is a huge opportunity to make big cuts to the government, but these are going to be painful. Let me get out ahead of that and say that I believe that these are going to be painful. Thank you, Lori. Elon's worth $304 billion. Wow. Stunning. Also, Ange, could you check in with Jason? He has his hand raised. I want to make sure we get with him.
I was just typing to him right now.
Okay, awesome. So Elon's worth $304 billion, worth a few bucks. So these opportunities for Doge to cut jobs, to make the government more efficient, they will be painful also. I want to make that clear. We're talking millions of jobs potentially. So we have this insane debt. Who do we owe it to? How much exactly? And where is it broken down into? Like I said earlier, we're looking at 35.8 trillion in US debt as of today. Now, obviously, that also will have interest costs that will continually increase because we're not paying down that debt. We're not even paying neutral on that debt. So that is something that will increase over time. This is a good slide. There's a lot here. The US national debt currently sits at 123% of annual GDP. This is a ratio. There's a very, very powerful ratio that we use in economics and geopolitics to see the health of a country and what their economy looks like. And that's debt to GDP ratio. The US sits at 123% of a debt to GDP ratio. Now, again, a couple stats we've already been through, but the total interest for 2024 on that debt is 892 billion. These are substantial numbers, but we're just in a weird place where even though it looks so bad, it's so much worse in other parts of the world. To give you perspective on how bad debt to GDP ratios can get throughout the world, China's debt to GDP ratio, we're at 123 in the US. China's debt to GDP ratio is 286%. Okay. That is over double what we are at. Okay. Now, China's biggest issue, how they reached such a just massive amount of debt to GDP, is that they had massive spending projects with a negative return on investment. Okay. If you do that enough times and you do that consistently, it will snowball into what they're dealing with, which is an economic crisis. Historically, the US debt was less of an issue because when we spend money in the US, typically we get a positive return on our investment there. This has changed recently. As of Q3 2024, for every $1 that we added to GDP, we took on $1.7 in debt. So this is a negative return on our investment. That is new for the US. Typically, we were in the positive on that. So a little more debt wasn't a big issue because we were making a higher return on investment than we were spending. So in short, this is a massive risk for the US today. Here's a good breakdown. Just a quick look. Who holds our debt? First and foremost, our brothers and sisters in Japan, dear allies of ours. They hold over $1 trillion of our debt. Next, we have China, 749 billion of our debt held by China. Now, let's do a thought experiment here. If China and the US goes to war, if China and the US were to go to war, would we pay on our $749 billion debt? Probably not, right? I think China's smart enough to realize that. I think they understand that a war with the US would have horrible impacts, would essentially devastate their country, but also they'd get stiffed on about $750 billion. So one of the nice things about other countries holding our debt is that they're disincentivized to stir up anything beyond, trade wars or cold wars, right? They don't really want a hot war with the US and get stiffed on such a huge amount of money. We have the UK, we have Canada, beloved allies, long-term allies of ours that hold our debt. It's good for them. It's good for their economies. It's good for their holdings as countries. Now, the remaining 4 trillion of our debt that's held abroad is held by about 30 countries. Now, let's note who is selling off their US debt. The big three: Russia, Indonesia, and China. Russia and China. Let's drill down there. Russia, it's pretty obvious. They don't love us right now. We're at odds. We're kind of in a proxy war. Ukraine stuck in the middle. Just today, Joe Biden approved some long-range strikes into Russia. That's all heating up. That's not on the way down. Although there was some optimism with Trump stepping into office, that there seemed to be a potential discussion to be had for winding down that Russia-Ukraine conflict. But Russia's selling off our debt. They are selling our debt back into the marketplace. China also. I think they also realize, again, 749 billion is a lot of money to hold. The good news is, out of all the countries' debts in the world, the US is the highest rated. Most people probably know that. We have a pretty sophisticated list here today. But if you weren't aware, the US debt, US treasuries are very highly regarded abroad. However, 2/3 of US debt is held domestically. So if 1/3's abroad, the rest is here, domestic. So a quick look at, some different groups, some different structures of people holding our debt at home. Now, this didn't really have a structured place in the presentation. We just threw this in. We wanted to show you guys a quick compare and contrast about the two, the two candidates. Trump won. We're going to lean into what we're dealing with specifically, but just a good comparison here. Maybe this is a kind of a screenshot chart for y'all if you were interested in seeing what that might look like. All right, back to debt. Now, a huge portion of US debt is what's called intragovernmental. What this means is it's government agencies trading debt amongst themselves. Don't quote me on this. Don't quote me on this, but I believe it's about half of domestic debt is intragovernmental. As a matter of fact, if someone pulls that up, let me know. It's a substantial number. I think it's around 50%. But what this is government agencies trading, hey, you need a few bucks, we'll give that to you. We need a few bucks, we'll borrow that from you, right? This is economists will downplay government debt in the US and say, it's like the right pocket, left pocket analogy. It's not really a big deal. I hate that. Personally, I'm just going to talk personally for a second. I absolutely hate downplaying the US debt situation, because all that does it removes pressure from our politicians to solve this crisis, right? So I don't think we should be downplaying intergovernmental debt at all. I think it's a very real form of debt, even if it's owed to ourselves. But it isn't as bad. Objectively, it is not as bad as owed to a different third party. There we go. So about 1/5. Ange, thank you for dropping. About 1/5 of US government debt is intragovernmental. It's a little less than I thought, but substantial. We're talking trillions, right? So we've set the stage. A lot's going on, lots of risks, lots of debt discussions. What risks specifically are tied to this debt snowball that we're staring at? One is reducing private investment and slowing the economic growth. Why? Because the economy we have a weight around our neck trying to figure out this debt, because somebody's got to pay for this at some point. If we get our arms around it today, then we get out ahead of it getting worse, but it will slow down the economy necessarily. It has to, right? On the flip side, we have increased interest payments to foreign entities. We are sending money abroad in that case. We're sending money off of US shores and stimulating other economies. We owe them the debt. We need to pay them, right? But as it grows, we're sending more money abroad. We've talked about some of the other ones. I'm going to highlight one last one, and that is interest rates. As we deal with things like treasury issues, etc., we stimulate treasuries to rise, which, if you haven't seen the odd, peculiar thing going on right now, the Federal Reserve is dropping rates, but rates are going up. Why is that? The 10-year treasury's gone up. That has a more direct impact we're seeing today on mortgage rates than the Federal Reserve dropping rates. So not getting our arms around this does have big impacts. And then also, this is just kind of a personal one. I have kids. Many people here today have kids. We're passing the bill, and we all know this, right? We know that if we spend today on government services for today that we don't have the money for, someone's got to pay this bill at some point. We know that eventually what's going to happen is future generations are going to be paying the bill and not getting the services. That doesn't make me feel good. Some people write that off. Hey, I won't be around when that's the case. I don't know. I don't think there's a lot of honor around that mentality. I would say that we need to be honoring future generations of Americans. I think we need to be balancing better and not handing them the bill for services that we're spending today. So this is an interesting thought. Many people lump these two somewhat together. We're just going to take a minute to identify the difference. What's the difference between a deficit and the debt ceiling, right? The deficit is the total amount of debt the US has at any moment in time. Right now, 35.8 trillion. Not a small number. Debt ceiling, that is the limit of how much debt the US can hold. These are oversimplified definitions, but it's a good concept, and it's good to understand the slight difference. Okay. Politics keeps sneaking back in, but let's look at debt ceiling adjustments. Which presidents have adjusted the debt ceiling the most? We see Reagan takes the cake at 18, Obama 11. We see Clinton and Bush in there with no small numbers as well. We consistently see this debt ceiling get bumped up. You don't see Biden in there and you don't see Trump in there, but both of them actually had less debt ceiling adjustments. The difference is that their debt ceilings were a lot higher. So we're agreeing on higher numbers. I don't think that's a good thing. I think that's actually a bad thing. I think limiting our spending much more, the debt ceiling really can kind of be like a governor of a car. We can't accelerate past a certain amount. We can't blow past too much without having to adjust something or get something back on track. Now, we could talk about how the political parties are using this strategically to extract their own policies and how they're spending a lot less focus on readjusting the debt and much more on getting their own, political goals met. But that's probably for a different webinar. So the debt ceiling, we pretty much covered most of this, but it's been raised with less frequency during the last two presidencies, but with much higher limits each time. So let's dig in a little bit more in depth on specifically Trump's tax and tariff plans moving forward. So the TCJA, right? 2017, we know a lot's going to expire in 2025. We went over a lot of this. This is mostly a recap, but here's what's new. And here's the biggest point of this slide. There are some new things on the docket, new discussions. Eliminate taxes on tips, overtime pay, social security benefits, create a tax deduction for create a tax deduction for interest on vehicle loans, and eliminate the green energy subsidies of the Inflation Reduction Act, a policy from the Biden era. Now, we started off by talking about, does income tax actually, does tax the rich actually work? There's a whole lot of debate there that we could dive into. But what we do know is that we haven't figured it out in over 100 years. If we just target the middle class and try to fix things for them specifically, maybe that's a different route than trying to punish people on whatever side of the tax spectrum that we're looking for. What Trump is talking about here is eliminating income taxes on tips, overtime pay, and social security benefits. I like this. If we're trying to help out the middle class, this is very targeted. I think this is powerful. I think this has a good opportunity to be a good impact directly on people that both sides of the aisle are saying they're trying to benefit. The vehicle loans, okay, yeah. I mean, hopefully that stays, hopefully that goes to a lot of companies that are stateside. We'll get into kind of the benefits of some domestic companies, of how all these plans could benefit them. And then the green energy thing, I mean, it's, the Inflation Reduction Act, Trump kind of has that in his targets right now. A lot of that will kind of get probably rolled back. There's a lot to say there. I think the environment's very important. When you benefit the environment, the worst case is you breathe cleaner air and drink cleaner water. I mean, how bummed are we to have a cleaner environment for us all to experience? The difference in the issue is if it's expensive, simply put. Right now, we have an economy that's in a very tough situation. We have a lot of people unhappy about where we're at, specifically with a lot of the increases in goods and services, a lot of the inflation. So the green energy subsidies, probably not as high of a priority. All right, let's dig into tariffs. A big, big question. One of my biggest concerns, candidly, So to make sure that we set the stage for this, Trump is proposing significant hikes in tariffs. Unlike, a normal tax law change, the president actually can use executive privileges to change many things in the tariff, on the tariff topic. Trump has so far talked about implementing up to a 60% tariff on imports from China. He's talked about limiting some investment options in Chinese sectors, restricting semiconductor exports to China. I mean, 10 to 20% tariffs on all imports, right? So significant import amount, or excuse me, significant tariff amounts on all imports. And this is one I'm just not too sure about. Tariffs on aluminum and steel from the European Union. It's tough. These are tensions that are being added to allies. I'm not sure where I sit exactly specifically on the tariffs to the EU. The China one's interesting. To make a note, these are kind of the middle of the road numbers that we're putting down here 60, 20, 10 to 20. Trump has mentioned going as high as 100 to 1000% on tariffs in certain circumstances. He's also advocated for, some more extreme things like exiting the World Trade Organization altogether. So there are some big things that would significantly impact the United States' place in geopolitics and specifically global trade. If we look at trade already, we know that US imports are over 1 trillion that are sold directly to consumers. That's setting aside the amounts of goods that we bring in and that are manufactured here. Okay. So this is a lot. What's the point of tariffs? There's two questions. The first is Trump has leaned into that tariffs are a revenue source. I don't fully agree with that. There's a lot of reasons why this might not be the case. The first for tariffs is that they disincentivize imports, right? That's the point of tariffs, is that they make imports more expensive. The benefit of tariffs and how they were used historically, especially in the US, was to boost domestic industries. So if goods from China are 60% more expensive, that gives 60% more breathing room to US companies to compete on that same good or service and the same manufacturing. So the opportunity is that US manufacturing, US manufacturing and building can have the opportunity to compete with other countries like China. Necessarily, if tariffs are on outside goods coming in, the reality is over time, if those goods and services are increasing in the US, those tariffs are likely to decrease. So over time, over time that reduces the income we would receive from tariffs while increasing the domestic manufacturing. So I don't see the argument that Trump's making some of the time on tariffs being a major revenue source, but I do see the opportunity to boost domestic manufacturing in a big way. Just some quotes, some interesting quotes. Also, I'll note historically, I've been against tariffs. Now, there's an example that gets thrown around where, and some of these numbers are a little bit looser, but where there was a tariff assessed to washing machines. And what ended up happening was the amount that we received from tariffs on this washing machine that was being imported ended up costing the US consumer something like 5 to 10x what that tariff generated in revenue. That's kind of what, especially the left, is leaning onto examples like those. Now, here's where this gets more interesting. And here's where I'm not too sure about tariffs. I might be changing my tune. I'm looking closely at what the data shows coming up. We live in a complex world today where tariffs are rebalancing the imports to the US, where the biggest global economy, the United States, is now creating a weird structure where people are kind of bidding to bring goods into our very consumer-led economy, right? We've actually seen, since the tariffs of China have been applied, we've seen Chinese imports increase, not decrease. That's unexpected. That's not normally how we expect tariffs to be shaking out when something like that is applied. So we'll drill down a little bit more, but that's something that's in the back of my mind as I'm reading this new data and kind of a new structure economically and geopolitically. So let's kind of think through an example. If you're a tier 3 country, right? We won't define what that means, just maybe a country that's growing, a growing economy, industrializing, trying to catch up to other parts of the world, a GDP that's on the upswing, having access to the powerhouse of the United States economy. I think our GDP, 25 trillion? Maybe somebody could spot check me there. 24, 25 trillion is our current GDP. Having access to that much buying power is sometimes that might be worth paying an extra high price to get access to that US economy. So that's the argument that I'm hearing right now on the pro tariff side from people that are very intelligent, in the economic world. Again, the data will tell us if that's accurate. So the China example, assessing those, tariffs to that, it's actually boosting local economies we're seeing. It's boosting manufacturing locally. We are starting to see the earliest phases of that. So Trump hammering China, there's a lot of reasons he's doing so. There we go. There we go, Ange. Perfect. Is trillion, right? Am I reading that right? Okay.
Google says billion with a B.
Okay. Okay. There we go. Um, so one interesting note though, while we're boosting economies, while we're trying to protect US, um, oh, there we go. I understand the number now. I had to read it quickly. Yeah, so 29 trillion. There we go. US GDP. All right. So as we are building in and baking in tariffs into our economic strategy moving forward, we are also leaning into a lot of incentives to bring US manufacturing back home and US energy going through the roof. So drill baby drill is back in play 100%. So I don't think anybody, if you set aside the environmental discussion that we had earlier and you just talk economy, I don't think anybody argues with the fact that having access to more gas, more petrol, more liquid natural gas, more energy in general in the United States, that's deflationary. By its very nature, having access to cheap energy allows the country to reduce inflation on that side. And if you put aside the economic or the environmental impact, this is probably great for the country. And Trump is leaning all the way into it. Okay. So we went through some different angles. We went through some background of taxes. We went through some background on the debt. What exactly does this mean most importantly for you, the investor? For you, how are you going to spend your money? So, you know, your goal is to optimize your investments. Your goal is to stay diversified. It's an interesting time. How are you going to do that? Well, the number one thing that a lot of this seems to be bringing to the table, we are seeing the question of inflation come up again and again. I saw a lot of my fellow investors in the real estate world, they stamped inflation as solved, right? We started to see inflation go down, 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 all the way to almost 2%. We were at 2.2% inflation, but then it started ticking back up. So, where exactly are we at with inflation? I would say, we include some of these slides in the last handful of webinars because it applies to so many different topics and it is so pertinent to what we're dealing with. Here's some quick stats for you. We won't over drill down. We're just going to go through the biggest and most impactful. Since 2020, the United States has printed nearly 80% of every dollar in history. Okay. So for 200 years pre-2020, we printed 20% of every dollar. And then in the last handful of years, we've printed over 80% of every dollar that's ever existed. That's mind-boggling. That's mind-blowing. In perspective, to put this into perspective, in 2020, there's 4 trillion US dollars in circulation. Now today, there's over 20 trillion in circulation. It's shocking. Okay. Now, is there any problem with that? I don't know. Let's dive into what the numbers might look like if there was a problem. At the beginning of 2021, inflation was at 1.4%. Right here. See this? January 21, 1.4%. Then we started seeing some increases. We had Miss Janet Yellen. She's done great things for the country. She's also done some not great things for the country, right? She was the previous Fed chair prior to Mr. Jerome Powell, okay? She was screaming at the top of her lungs, inflation is transitory. Inflation is transitory. Now, we know 17 months later, we went from 1.4% inflation to 9.1% inflation. Now, I know, I'm positive I don't have to say this. but inflation was not transitory. Okay. Just to put, just to make sure we dot that very clearly and put it on the nose, inflation was not transitory at all. Since that time, we've seen the largest rate hikes in history. Or excuse me, we've seen the steepest rate hikes in history. The highest rates we've ever seen, 70s, 80s, to be 100% clear, but we saw the steepest rate hikes in history in modern times. Okay. Now, again, we saw inflation settle down. We saw 3% 2024 all the way down to 2.2%. What happened in the last two reports, guys? We started ticking up 2.3. Now we're at 2.4, and the Fed is still talking about reducing rates. Okay, you heard that right. The Federal Reserve is still saying on their federal dot plot, they have an expectation of the next 2 years to be reducing rates 1% a year for a total of a 2% reduction in rates. We have increasing inflation. I've been shouting this on podcasts at the top of my lungs, saying that inflation is not resolved. Okay. We're starting to see the upward pressure more and more. Some impacts of inflation, what we're dealing with on that side. We've lost over 25% of our buying power. Okay. Dollars have lost over 25% of their worth. Unemployment, okay. Home prices have gone up over 45%. Mortgage payments are over 111% up. And we still have inflationary megatrends globally, not just in the US. So inflation is here to stay. There's a lot we have to navigate. So when we think about the Trump policies and their impacts, we have to understand that there are many things to balance, and inflation is definitely one of them. If we take some of the biggest names here, we're looking at Rick Reeder, we're looking at Bill Ackman, Howard Marks. These guys are betting 10 to 20 years of inflation ahead. Between the gentlemen on the screen, we're looking at trillions under management. Some of the brightest minds in finance. Bill Ackman made like 200 million in a month just betting on the right side of, what was it, treasuries? I think it was treasuries about a year ago. I mean, these guys are stunning minds in finance and investment. So there's a lot we can drill down into here. We're going to cover some of this in a minute. I want to save the most time for the next sections. I want to make sure we focus on these. Again, we're going to slash through predictions. We don't make predictions. We make projections. We do educated projections on what we're seeing. What will be the biggest winners and what will be the biggest losers coming up? Let's start with the biggest losers that we see. The first, government-funded projects, government-funded companies, government-subsidized industries. That includes all kinds of welfare systems, different services, etc. Why? I think Doge, if they're doing their job properly, there's going to be deep cuts. They're going to be analyzing a lot. I think a lot in the government sector is going to be under a microscope. And I think you're going to have the Department of Government Efficiency making some cuts across the board. So that's one of the losers, is a lot of things around government funding. Another one, I think, is import strategy businesses. You're going to see these guys dealing with huge tariffs. They're going to have to navigate complex situations there. And by extension, one of the biggest losers here is China, period. China is going to have a lot to deal with. They have a lot of headwinds dealing with the U.S. economy, Donald Trump particularly. Again, President Joe Biden extended the Trump era tariffs. Okay, so this isn't a Republican issue. This is both sides of the aisle. Biggest losers, I'm saying inflation is going up at least 1% increase. So 2.4%, we might go up into the mid threes if we don't have a Federal Reserve that's responding appropriately, managing rates. So that likely means we're either going to be dealing with higher inflation or higher rates. Those are the losers, the biggest losers in this scenario. Hold on. Let's see. Hold on. Let me get organized. I want to make sure that we don't. There we go. Okay. So back to tariffs for 1 second, just in the context of what we just talked about. I added this slide on a second time. I want to make sure we put this on the nose. Well, I think tariffs have a huge risk of causing inflation. Okay. We just went through a whole cycle of going through what the inflation looks like in the US. I still think this is one of the biggest opportunities for US manufacturing to absolutely soar. Bringing manufacturing, bringing industry back to the US, a consumer economy for the last handful of decades, and really redeveloping our manufacturing structure. I think tariffs are going to be probably a net neutral if you think about them, but the winner of tariffs, unquestionably, I believe, is going to be the manufacturing sector. Hold on. We got these out of order a little bit. So I'm going to jump back here. The biggest winners. The biggest winners. Let's jump into the winners here. Oh, I'm sorry. I'm getting jumbled on the slides. We got a few slides. The next is the bad news is savings accounts, CDs are in a tough place. All this being said, why? Because we have a Federal Reserve that is actively trying to reduce rates at this period of time, while also dealing with the uncertainty in the investment market. We don't see banks trying to up their CDs and up their savings accounts returns. So I think in an inflationary world, especially, cash is dead, and cash is worse than dead. It's a risk. Sitting in cash in inflationary times. Remember the Janet Yellen slide? 25% of the dollar's value lost. If you sat in cash for that period of time, you took negative 25% return. So that's what we see very clearly there. Savings accounts, same thing. I just think you're barely going to stay afloat. Probably won't beat inflation. I think if you're talking about strategy in investing, savings accounts are dead. CDs, I think it's the same situation, just not enough return to justify the risk in an inflationary environment. So, biggest winners. Let's talk winners a little bit. Commercial real estate. Unquestionably, getting a Donald Trump stepping in to another presidency, and with the incentives that are circling and with the environment we're in, real estate is absolutely the front runner for biggest winner. Now, let's talk why. If inflation is as sticky and as pronounced and as difficult as we see some of the biggest names say it is, then you want hard assets, right? Especially for a growth strategy. This is highlighting the number one growth strategy specifically. So you want to be in an asset class that as inflation goes up, the value of the asset also goes up. Real estate historically has proven that over and over and over. The value of that hard asset is very pronounced in inflationary markets. Now, the next question, we have a lot of smart investors on here. What happens with rates? Really, is commercial real estate really the best place to be parking money if rates may go up dramatically? The answer, in my opinion, from our studies, what we're digging into is unquestionably yes. Why? Because there's two big numbers when you're buying a property, when you're buying an asset in real estate: the purchase price and the rate at which you're paying your debt down. Rates are short term relatively. The reality is you can refinance a rate. You cannot refinance the purchase price of a property. And when rates are higher, that's downward pressure on purchase prices. So I'm less concerned about rates maybe than the average person, especially as you know we full-timer investors. So I'm more concerned about the impact of rates on other asset classes. I'm more concerned about things like equities in this environment, right? So if I was going to be buying real estate, if we are going to be making projections of the best operating asset classes in commercial real estate, we've already said it, but I'll just highlight it. It's manufacturing, it's distribution facilities, it's industrial real estate. It's really looking like the shining star moving forward in the Trump economy that we have ahead. Trump is so America first. He's open about this, right? He's very, very clear about the fact that he's very America first. We have drill, baby, drill. We have huge tax write-offs that likely, you know, if we looked at Trump the last time around, he had huge incentives. And the question is, because we're talking about growth, What else would you invest in other than real estate? The most obvious one's going to be equities. Here are two case studies, or here are two extracts from analysts at Goldman Sachs. Excuse me. Here's the study that just got released by Goldman Sachs. Goldman Sachs expects the S&P 500, the 500 best companies in America, to return an average of 3% a year over the next 10 years. Let me say that again. Goldman Sachs is expecting a 3% return per year on the S&P 500 over the next 10 years. Now, we just saw inflation ticking up. It's at 2.4% with the last report. So, assuming it didn't go up, which I believe it will, I think we're on an upward trend for inflation. All that risk in equities for 0.6% return, I'm out. No tax advantages like real estate, I'm out. Not as much cash flow as real estate, not as much hedge against inflation as real estate. I am out on equities if we're looking at a 3% return, which is per Goldman Sachs. Look at some other big names. The Investor Business Daily recommending downsizing stock portfolios, et cetera, et cetera. So I think there's headwinds in equities. I'm not putting my money there, and I don't think that's the best growth strategy moving forward. Now, let's say you're a fixed income investor, right? What is the absolute winner that we are seeing in the fixed income space? Without a question, I believe it's mortgages on single family homes. Why? Because let's go back to the basics. Inflation and rates. The first, if inflation increases, property values are likely to increase. We established that. That's a long-standing trend in real estate. This, if you're buying mortgages or you're investing in mortgages, this increases the value of the collateral of the debt that you're buying, aka the single family home, someone paying that mortgage, right? This added value improves the safety of the investment because as that underlying asset value goes up, the individual is more likely to make their payments. They don't want to lose that increasing value of their investment, right? So in this way, inflation actually benefits or can benefit strategic debt investing. So that's one. Inflation benefits mortgage investing from that angle. The second is rates. Again, rates are short term. They adjust and change over time. You know what? We might even have a whole slide here on that. Yeah, here we go. Okay. So if rates go up, I love this. We drilled down on this a few times for a couple investors who requested. So we just ended up adding the slides. If rates go up, mortgages are more stable. Why? Because if you have a mortgage portfolio and rates go up, let's say your portfolio averages 6%. If mortgage rates then go up to 7% on the market, they're way less likely to refinance because their monthly payment's going to go up. So cash flow is more stabilized from that perspective. There's also less turnover in the portfolio, creates more stability. And the other, if rates go down, that stimulates buying, which increases the property values. Again, that's a positive. That stimulates investment. We're all fine with underlying values, with the underlying assets increasing in value. That only improves the investment position. So we went through our biggest winners. We believe it's going to be commercial real estate, specifically industrial real estate. Now, this is a little premature, but I'm going to let you guys in on a secret. It's kind of an announcement. We've held off on investing in real estate for a period of time on the hard asset side because the market had some sorting out to do. It had to figure itself out in some different ways. The good news is the way that we invest and the strategies that we use to invest on the acquisition side, it's a good time for us. And we're starting to see really strong trends, specifically in industrial real estate, which is our background. If you check out our website, we have all kinds of deals that we've done in that space, averaged over 35% on those deals. We are starting to see really good opportunities for us to be entering the market. So we are telling you now that if you are looking for investment opportunities with Saint in the industrial real estate space. They will likely have a tax benefit. John, I know you asked this question earlier, so I wanted to make sure to get back to you. These investment opportunities will have a tax benefit. They will have some cash flow along the way, and they will have a participation on the upside of these deals. That's the most likely structure we're going with. They will probably be longer hold periods. Think around 5 years, but this is an early announcement. In the next handful of months, we will likely have more data, or excuse me, we'll likely have more information on this. If you are interested and you want to learn more, what should we do, Ann? Should we drop a calendar link, let them book a call, get with Luke and have some discussions on those?
I think that would be amazing. The
Perfect.
personalized investment strategy calls are fantastic. I'm going to drop the link right now.
Amazing. So this link, you can book a call directly with Luke. He's our head of investor success. He will personalize an investment strategy call based on where you are at. You can click on that link below if you're interested in learning more about investing with Saint on some industrial projects that we will have coming up in the coming months. So hopefully that answers your questions. There's a lot of benefits to those, but they are longer term. Those are probably 5-ish year investment horizons. But if that fits well for your growth strategy in your portfolio, then I definitely encourage you to book a call and learn a little bit more. And as always, our flagship fund still today, tomorrow, etc., is our income fund. That's based on over 500 single family mortgages in over 21 states. Returns go up to 14.28%. And if you want to book a call with Luke, you can check the chat. You have a link to the calendar in the chat. You also have a QR code here, or you could text wealth to 949-787-0957. This fund is booming right now. We have a ton of interest. We have a lot of amazing people that are here today investing in the income fund with us. And also, the first, we typically sell out of opportunities, especially on the syndication side, on the growth side. Our investors on the income fund always have first opportunity to invest on the new offerings that we have. So I highly encourage you to learn more about our income fund. It is killing it right now in this environment. This fund was asked and requested from our most sophisticated investors that were looking for an income opportunity to balance out the uncertainty in the market.